What's up, Banter fam? Welcome back to the show. And in today's show, I'm going to be going through 5 altcoins, which I think have potential to perform very, very well in the next bull run. And we're going to be digging into some research today to substantiate which projects could be the ones that perform the best on the way up, because now is the time to start building our watch list, start building out a nice little portfolio of projects that we're eyeing. And at the end of the show, I'll be showing you my DCA strategy for accumulating these projects, and I'll show you my price targets at the end of the show for the Bitcoin price and where I think the market may be headed. It is going to be a massive show, so let's get straight into it. And the first project I want to talk about is Solana. We're going to start off with some of these bigger caps and then progressively get more degen throughout this video. But I do want to talk about Sol because when I look at the layer ones right now, Sol is one of the only layer ones that I feel comfortable actually accumulating. And that's for a few reasons. It's due to its VC backing. It's due to its market cap. It's due to its community, but it's also due to some statistics which I've been digging through over the last few weeks. And it's become clear to me that the Solana blockchain is not going anywhere because it has such a high transaction volume relative to other chains. It has a very strong NFT community, and it also has a lot of active wallets. Now, you may be noticing over the last few days, we have gotten a massive decrease in Sol volume, both transaction volume and the number of daily active wallets. This is off the back of the NFT volume, which has been decreasing, which is down 26%. But even though these numbers are scary, and even though you might be thinking, oh, Solana's losing a bit of steam after it went on an absolute tear with the data that I'm showing you here, I'm actually more bullish than ever because I like the fact that we're getting a little bit of heat pulled off the market at the moment. We are seeing some of the artificial numbers being stripped back from the Solana price, so we can focus on fundamentals, because the reason I was investing in Solana wasn't because of its artificial NFT volume. It wasn't because of the crazy pumps that we see in the transaction volume. It's because I'm a big believer in the tech. So let's take a step back for a minute and look at why I think the tech is solid, and look at long-term where Solana actually may fit in to the L1 ecosystem of crypto. So the first thing I like about Solana is that it's obviously proof of stake, but it utilizes a unique proprietary consensus mechanism. And this is the proof of history mechanism to achieve scalability. So proof of history, what it does is it allows individual nodes to validate transactions with small pieces of information. This means Sol can achieve a very high throughput relative to other chains. This means Sol can scale maintaining a single global state, meaning it doesn't rely on L2s to achieve scalability. So what we'll see with a lot of chains, and Ethereum is included in this, is it will fork off to other L2s, and we've seen this with the AVAX subnets to achieve scalability. So we see some chains utilizing parachains, subnets, L2s, and what this does is it allows chains to divert transaction volume from the main chain to these subnets, to these parachains, whatever you want to call them. However, Solana has taken the active approach to maintain a single global state, which means that the chain scales by itself. So it doesn't rely on L2s, which means you can keep liquidity in one ecosystem. So we don't see liquidity being fragmented across multiple ecosystems. Yes, this has created issues because it's very hard to scale tech like this, that Solana certainly isn't taking the easy way out, which has meant it has been prone to some flaws, which have resulted in some downtime, some DDoS attacks, etc. But I'm betting on it for the tech, and I'm betting on it because it has a theoretical limit of 700,000 transactions per second, and on testnet it achieved highs of 65,000 per second. So it does have a very scalable consensus, and also, since it isn't EVM compatible, it's built this own ecosystem in its own right. So you can't just access Solana or MetaMask. It uses its own software, which means that it's kind of built out its own proprietary ecosystem. And we've seen a very big ecosystem build out on Solana. So I do like it as one of the safer plays. It isn't necessarily one of those plays that's going to make you a millionaire overnight. But in terms of DCAing during a bear market, we want to be looking at some of the safer chains with some tangible growth and metrics that underpin them. And Solana certainly has that. When I did this thread, it was a few weeks ago, Solana actually had more active addresses than BSC and Ethereum, and it was doing roughly 10x the transaction volume as Ethereum. However, obviously over the last few days, we've seen these transactions drop off a little bit as a result of some of these NFT sales going away. But still, it's still doing 1 million transactions per day. as we can see on this sold transfers chart here. Yesterday, it did 3.51 million. At its peak, it did 20 million. Ethereum, just for perspective, does around a million a day. So even with the drop off to a million, it's still the same amount of transaction volume as Ethereum, which is a testament to the low gas fees and the scalability that it does have. But I thought I'd start with a little bit of a safer one here. And just beware of the supply curve. I think one thing you have to be aware of when you're investing in L1s or any project for that matter is how the supply is entering the market. You don't want to be dumped on by VCs. You don't want to be in a situation where you buy before major unlocks. So I did want to show you the unlock schedule here, and we can see that we are in June 2022, which means that the very steep portion of the unlocks has already taken place, but there is still roughly 35% of the total SOL emissions yet to come. I'd say markets aren't stupid. I'd say markets usually price this supply coming onto the market in before it actually comes onto the market. However, it is something to note that there is still supply to come. And obviously, this is important for validating the network. You'll note that most of the VC unlocks have already taken place. The SOL dilution at the moment is mainly geared towards network validation, which is obviously important to keep a network secure. So I do like Solana. And that is one of my first picks if I had to pick a portfolio of 5 projects. Now, Kyle actually is going to underpin some of my fundamentals throughout this video with some nice charts. So I asked him overnight, I said, can you come up with some charts for me? And he came up with some charts for some of the L1s that I'll be talking about today. We see that the Solana resistance is at the $50 mark. We're currently at $46. We see major horizontal support around the $42 to $43 region. Of course, we did wick down to 35. So if Bitcoin did take a massive hit, it's not unlikely that we go and gobble up some liquidity down the $35 region. However, when I'm buying SOL, I'm looking for these pullbacks. If we do break through the $50 region and Bitcoin pushes up to 36K, then we'll want to buy the retest of this trend here. However, if we get rejected, then we might want to look at accumulating closer to some of these horizontal lines. But as I said at the end of the video, I'll be going through my exact DCA strategy for Solana. Now, talking of charting, I think it's amazing because Sheldon just launched his new charting show on Crypto Banter. And you guys are probably aware of it if you've seen it, but he basically hops on for 3 to 4 hours and live charts with us. And I wanted to get involved because I didn't just want to sit on the sidelines and watch Sheldon putting through all these profitable trades. I got a little bit of FOMO over the weekend because Sheldon hit a very, very nice trade on Theta and Solana. So I thought, how can I get involved? So I funded one of my ByBit accounts with 5,000. Sheldon did recommend starting with $400. For most people, under 1,000 makes a lot more sense. I'm a little bit of a degen, so I put in 5K, but I'm going to be trading along with you guys on ByBit and trading along with Sheldon. I think it's a fantastic idea doing live trading on the show. So if you do want to get involved, as I'm getting involved, there's a link in the description to sign up to ByBit. We're also going to be doubling portfolios in the show if you use that link, but make sure you get an account while you still can, because I think this is going to be an awesome series that Sheldon does on the show. So remember, link in the description if you want to sign up for ByBit and get involved with that trading challenge. I'm going to be posting and keeping you guys updated on these shows as well with how my trading is going in this challenge. So I'm very, very excited to be joining in on that. All right. Number 2, I did talk about this on today's video. The number 2 L1 that I'm looking at accumulating is Near Protocol. Now, I did a much more in-depth video, and today I'm going to gloss over some of the key facts that I highlighted from that video. But if you did miss yesterday's show, I recommend checking it out if you want to learn more about Near Protocol. Now, Near Protocol is an interesting one because the price did take a bit of a hit after this USN announcement. So what they were going to do is they were going to launch this algorithmic stablecoin, which they did. But obviously, we had the UST fears starting to creep in surrounding algorithmic stablecoins, which ultimately led to the USN release being lukewarm. And it didn't kind of get the traction that a lot of us were expecting. But what it did is come out with a lower APR of around 10 to 12% instead of 30%, which I actually don't mind because Near Protocol going for a slightly less risky APR means that it is largely safer for investors rather than artificially incentivizing an APR through emissions. So we have seen a pullback in the Near price. So now I think it's an opportune time to start talking about Near again and really start doing some research into Near Protocol and work out whether this is something we should be investing in. And that's exactly what I've done over the last few months. And it is one of my favorite L1s now for that reason. And I'm going to go through some of the fundamentals and kind of break down why I do believe in Near Protocol. If you watched yesterday's show, I'm just going to clip some of my favorite catalysts for Near Protocol. So basically what Near Protocol does is it scales through dynamic sharding. So what Ethereum wants to do in 2023 to 2024 is it wants to implement scaling through sharding. Now, this is a piece of technology which allows a chain to become faster and handle more transaction volume. And it's basically one of the ultimate scalability solutions that we've found in crypto. However, Ethereum is still doing this in a couple of years, so we haven't really seen many chains implement it today. But Near Protocol came out and implemented it almost right away, and they're already using sharding, and this has resulted in a very fast, a very scalable blockchain which can handle a crazy amount of transactions. And I'll show you the amount of transactions in a second because it was mind-blowing just how active this chain actually is at the moment. So it kind of promises to be faster, cheaper, more secure than Ethereum. It's a narrative we've heard many, many times from altcoins, so that's not really what gets me excited. What gets me excited beyond the 100,000 plus TPS is actually the team and the ecosystem fund underpinning Near Protocol. So when we look at the major constituents of success in crypto, there's basically two components. There is VC backing. You need venture capitalists to come in and back protocols, A, for the connections, and B, for the financial backing. And then there's the development teams which are building on those protocols. So the protocols which have the best developers end up creating the best dApps which attract the best users over time. So when we want to look at L1s that actually have scope for growth and have a chance to accrue network effect, an L1 like Near Protocol sticks out to me for this reason because it has that stack development team. It ticks all those boxes. It's got a former engineer at Google who's running the show, as well as Alex, who's a very talented developer. And the main thing is it has massive war chest. So it has over $533 million in funding from almost every A-list venture capital. This includes Jump, Pantera, A16, FTX, Coinbase. Basically every venture capitalist that you can find has invested in Near Protocol. And when you have such large players banding together behind a project like this, it means it has less likelihood to fail because they all have a vested interest in Near succeeding, which has obviously led to this massive development fund of $800 million. And this fund basically incentivizes developers to develop dApps on the Near chain. And this is very important because when you have VC backing that leads to development like we're seeing here, it creates awesome dApps, which increases overall network usage. And that's one of the major reasons why we see network effects come into play. So Crypto Boomer did a thread here, and he said, understanding adoption and why Near is going to dominate the ETH competitor scene. For many people without an understanding in software, platform adoption in crypto, it can be hard to know what makes one platform different from another. He goes on to say that what adoption is he talking about? Teams and devs building on it. As I just pointed out, Near has the team and it has the devs. And this isn't a simple case of it being adopted or not. It's also the quality of the adoption. So this is a very good thread because it highlights the importance of these development and these teams coming in and making quality tech so we can actually get this network effect. And Near Protocol is a great example of that because we've seen an ecosystem come to light very, very quickly. We've seen multiple dApps, multiple applications launching a lot quicker than other chains have been able to. And if we look at the TVL here, Near and Aurora have accrued over $1 billion worth of TVL in a very small amount of time. In fact, if we look at the Near statistics, it was only just in September last year that we just saw the chain starting to pick up. So the fact that it has picked up such momentum in such a small amount of time is a testament to this funding. So if we actually look at the daily number of transactions, we can see that it's clocking around 680,000 per day. At its peak, it was doing 1.5 million per day. So just for a little bit of perspective, at the moment, the AVAX C chain is doing 200,000 per day, albeit minus its subnets, and Ethereum is doing 1 million per day, which is 35% more than Near. So Near's almost doing the same as Ethereum. It's doing the same transaction volume as Phantom. But I think the major statistic which stands out to me is actually the daily number of users on Near. It's not just ghost transactions like we see with a lot of chains. I would argue even some of Solana's transfers back in its heyday, December, January, a lot of them were slightly manipulated by the NFT ecosystem and the mass amount of mints taking place and the bots taking place in those mints. Whereas Near Protocol, it actually has a lot of active users that are actively using the chain every day. We can see its active accounts are roughly 10,000 a day. This is a 10x of what Phantom was yesterday. This is very, very close to Ethereum. And we're also seeing the transactions and the new account numbers underpin that. So when you're getting 200,000 new accounts per day on your blockchain, that's a very good sign that we are going to see some explosive growth in the future. You guys know how network effect works. The more users a chain can accrue, the more value that said chain can accrue. And the more users you have, it kind of operates on this compounding basis that new users talk to new users, which talk to new users. And you kind of end up getting this exponential effect of the number of new accounts, which leads to token value accrual with something like Near, because obviously you need to stake it. And you also need to burn it to put through transactions. So Near Protocol is definitely one on my watch list, and that is number 2 of a token that I'm looking at accumulating. And once again, I'm going to talk to you all about my accumulation strategy at the end of the video. In yesterday's show, a few people wanted me to talk about the tokenomics. People were pointing out the fact that there were unlocks to come. So I'm on Masari right now, and I'm looking at the unlocks. And I'm not too worried because it appears to me there's around a 35% dilution yet to occur. The majority of this occurrence is happening from staking rewards, but we can see that there is the core team, the foundation, and the early investors that are still getting some tokens here. So we're at the very end of this curve. We're in the last, 1, 2, 3, 4, 5, 6 months of VC unlocks. We can see that it starts to really taper off at this point. But just beware, there are unlocks coming at the end of those 6 months. Not something to be worried about. Potentially, if Bitcoin's momentum kept going downwards, then this may have more of an impact on the market than it usually would, because it means that there's less buy pressure and there's a similar amount of sell pressure. However, I'm not so worried because, as I said, markets usually price this stuff in. Investors aren't dumb. The smart money knows exactly when unlocks are taking place. So it's not something I'm too worried about, considering there's only really 6 months of crazy dilution to come, and then it starts to taper off a little bit. But just beware of it. And maybe it means you peel back your DCAs a little bit for the next few months in Near, and you kind of have it highlighted as a long-term bag that maybe you want to accumulate over the next couple of years. And, maybe in 6 months' time, that's when you ramp up your buying a little bit. It's all up to you and your goals, but that is certainly one I have on my watch list. Now, the next one I'm going to talk about is one I haven't talked about too much on the show. And it is one that's been slept on in the market in general over the last few months, as this narrative has kind of been a little bit out of favor. But I think it's one we have to look at during this bear market, because I think once the bull market comes back around, once we see some positive price momentum, we're even seeing a little bit at the moment, I think it'll really pick up steam. And that ecosystem, it's one that I know a lot of you guys like, and that is Polkadot. And Polkadot is one that's been slept on for quite a while. We can see that its market cap is now around the $10 billion mark. It slipped to roughly 10th on CoinGecko. At one point, it was top 5, top 4, and it was trading at around $60. So it has gone down. Let me get the exact number for you guys here. It has gone down 80% from its highs, and we're getting much better looks at accumulating DOT as we see it's tapering off. It's a very ugly chart, but the fundamentals remain stronger than ever. And I kind of want to talk about my thoughts a little bit on Polkadot, why I like it, and tell you guys what the play actually is here. So the thing with DOT is that they're going after a very long-term approach. My honest opinion is that the last bull run that occurred in 2021 was simply too early for DOT. The market started rallying. A lot of tech that was already existing, that was already shipping code, were the ones that were accruing TVL and getting a lot of hype behind them. So like we saw with Solana and its NFT ecosystem, Phantom and its DeFi ecosystem, AVAX and its GameFi ecosystem, these ecosystems exploded because the tech already existed and it happened in parallel with a major market rally. The thing with Polkadot is they were very slow to ship their code. They wanted to get things right and they didn't want to rush it. And it was in a similar position to ADA in the sense that we know the tech is very strong, but we saw little in the way of progress on the market. Well, that is actually shifting now because we had the second round of parachain auctions, which obviously resulted in some amazing protocols like Akala and Moonbeam. And now we're finally seeing some development activity coming back onto DOT, and we're finally seeing the transactions starting to uptick. So interoperability is a really big narrative, in my opinion, going forward. And I think it might not be today, it might not be tomorrow, it might not be in a year, but at some point, interoperability will be a narrative that picks up. I know it for a fact, because if we're going to have multiple chains in crypto in the future, we want a seamless experience when we onboard new users, and we want a seamless experience for transacting cross-chain, because basically, if crypto is going to get the mass adoption that we know is coming, we're going to need interoperability to make everything flow seamlessly. Now, Dot's UI hasn't been seamless, admittedly. Last year, it was a pretty awful platform to use, and that's also one of the reasons why the price didn't really reflect the fundamentals. But I think we're starting to get to a stage now where this narrative will pick up at some point, and it's one that I'm betting on because I know at some point it's going to pick up, and I don't want to be left behind when it happens. I'd rather get in when things are quiet than when things are going crazy. So just a few fundamentals on DOT. To succeed in an ambitious undertaking, the tech has to be the best. Now, it's a general consensus amongst the industry that Polkadot has some of the strongest tech in crypto. And it's my personal consensus that DOT has maybe top 3 to top 4 pieces of technology in crypto, in my opinion. And this is because it has inherent cross-chain interoperability. So there's no more bridges. This is an issue that Vitalik pointed out as being a vital flaw in crypto. It has no more bridges, and it has shared security. So there's no dicey validators. There's no validators that can be compromised, that overtake the network, and it's forkless upgrades. So there's no upgrade forks that need to take place that could potentially harm the security of the network either. So it's very robust technology. Obviously, Gavin Wood is heading it, and he contributed deeply to the creation of ETH, as you can see. Gavin and Vitalik here just chilling. He contributed to ETH. He went off and he started Polkadot. And he's a very credible, very smart guy, very smart developer. And they're taking the slow approach with this. But the slow approach doesn't mean that the developers aren't taking notice. I looked through Electric Capital's 2021 development report, and I saw that Polkadot is actually the second most developed on-chain in terms of active monthly developers since launch. So if we look at Ethereum, if I can zoom in here a little bit, if we look at Ethereum, we can see that coming in a close second in terms of total developers, around 1,500 versus Ethereum's 3,800 is Polkadot. And then third is Cosmos and Solana, the Near protocol as well. So there's no secret that the protocols I'm talking about in today's video are the ones that are showing development activity, because I know how important development activity is in terms of onboarding new users, onboarding capital, which obviously leads to value accrual over time in terms of the DOT, the SOL, the ETH token performing well. So DOT actually comes in second for development activity, and this has resulted in some great chains that have launched alongside Polkadot. So Moonbeam is the EVM compatible L1 that's launched underneath Polkadot. We've also seen Akala launch and actually gain a lot of traction in terms of TVL. We've seen it pushing right up into the top echelons of TVL here. Moonriver is number 24 for TVL, and then in the 30s, we see Astar and Moonbeam as well at 72 million. So relatively low TVL figures, but we have to remember how new this chain actually is. But since it's EVM compatible, it makes it very easy for people to bridge over Ethereum applications, Phantom applications, AVAX applications over to Moonbeam. So once we see some of this development taking place, we're going to see a lot of users start to bridge across to some of these chains. Now, this is kind of how I'm splitting up my Polkadot investment. And this is a fairly risk-off approach, and you can tailor this percentage based on your portfolio, but this is kind of how I'm investing in DOT. So I'm putting 70% of my Polkadot holdings into the DOT token itself. I believe that this is the least risky play because there'll be multiple L1s that operate underneath DOT. As DOT is essentially a layer 0, it's an architect network which has the capability to launch parachains underneath it, like we've seen with Moonbeam, Moonriver, obviously on Kusama, etc. So 70% of my dollar investment goes into DOT itself. Now 20% is going into Moonbeam because this is the highest risk reward play of the entire DOT ecosystem, in my opinion, because we're seeing a market cap of 366 million, and this has a lot more potential to become the top layer 1 on DOT, which obviously, if we just do some basic maths here. Now, I'm not trying to be crazy. I'm not trying to be a moon boy. I'm just giving you some comparisons. Let's say DOT, let's say Moonbeam reaches the level of one of these other major L1s. Let's say, I don't know, something like a Near protocol, for example. If Moonbeam, which is obviously the main L1 on DOT, reaches the level of Near, it would be an 11.6x. And now I'm not saying this will happen because obviously it has much less VC funding, etc. But you have to remember that the market scales. So you can't just look at L1s as a like-for-like comparison in terms of multiples. You have to factor in the overall multiple that the market is going to do, and then add that to your scaling calculations. So let's say the market does a 3x in the next bull run. Then this discrepancy then becomes a 30x if Moonbeam doesn't move. So then if it gains ground on near protocol whilst the entire market increases, then it becomes very feasible that it does an 11x whilst maintaining differentiation in terms of market cap from the higher market cap L1s like NIA. So when we're investing in a bear market, we're investing in the thesis that the entire market will likely move, which will likely result in some of these smaller L1s scaling up to their counterparts. So it just gives you an idea of the potential Moonbeam can do, because it's been smacked. It's been absolutely smacked. It's gone from, and I'm going to give you my exact entries in a few minutes, but it's gone from $13 with a lot of VC unlocks, roughly to, $1. So it has been hit very hard in this bear market, but it's one of the protocols that I'm looking at accumulating as part of my DOT stack. And then 10% I'm allocating to Moonriver. We know Moonriver is similar to, it's kind of like the cousin or the sister of Moonbeam, but it operates on Kusama. So it's the main L1 underneath Kusama. And what Moonriver gets is it gets a lot of the new shipments of tech, the new development that happens on Moonriver before it launches on Moonbeam. So Moonriver actually does have a good chance of gaining adoption prior to that of Moonbeam, which you may see a slight lag in development, because a lot of these dApps deploy on Moonriver first. I don't know which one's going to win. One might fail, so I'm betting on both of them. So I'm going 70% DOT, 20% Moonbeam, and 10% Moonriver. But that might change in the future if I find some other protocols that I like under the DOT ecosystem, and there's many great dApps coming, so I'm sure that'll be the case. All right, so we've covered NIA, we've covered Sol, we've covered DOT, three very kind of big L1s, and I've also covered Moonbeam and Moonriver underneath them. There's one more project I want to talk about, and it's one that's been hit the hardest in this bear market, or not the hardest, but close to it, because of its mechanism in terms of its native asset pairing, and that is Rune. I want to talk about ThorChain now, because it's a protocol that a lot of people wanted to ape into at $12. I was saying, wait for the pullback. It looks a little dicey. It was just kind of exploding. There's a lot of FOMO there. But now we've seen it finally cool off. So I feel like this is a good one to start looking at again. And this is obviously one of the essential dexes in crypto if we do want to go towards this interoperable future, towards a more secure future. I think ThorChain offers some great technology to be able to do so. So if you guys don't know what ThorChain is, it's a dex that enables you to keep custody of your assets. So you can execute non-custodial swaps, meaning you can swap, let's say you want to swap Bitcoin to Ethereum, you can swap from Bitcoin to Ethereum on the same chain without bridging your assets across to Ethereum. And how this is facilitated is it has Rune pairings in the Omni pool. So if you have Bitcoin, you're swapping for Ethereum. What this does is it swaps one-to-one with Rune, and then on the other side, it will take that Bitcoin that it swapped with Rune and redeem it for Ethereum, and it utilizes the pools in order to do so. So this has many benefits. It's obviously more secure than utilizing some other dexes that potentially are involved with bridges. We've obviously seen that's been a weak point of DeFi historically. And also ThorChain has this pretty awesome value accrual mechanism where the Rune price actually captures value based on TVL. So if the Rune TVL increases by $1 billion, we can roughly expect a market cap increase of a 3x versus the TVL increase, because obviously Rune needs to be paired equally with other assets, which means there's buy pressure on Rune as more TVL comes in. So if you deposit USDC or Bitcoin, you'll need to have Rune in the pool to pair with those assets. So we have seen Rune accrue value at roughly a 3x speed to what its TVL accrual is. However, this also operates in the opposite respect, which means if TVL decreases, investors go risk off, it crashes harder than other protocols. And this is why it's tanked so much. But you have to be aware of, it's not exactly a flywheel, but you have to be aware of this reflexive mechanism. The fact that Rune does rely on a lot of TVL coming in to pump up the price. And this is why Rune runs harder than a lot of other tokens. When this thing runs, it runs. But that also relies on people willing to stake assets in DeFi. So this is a play that may not perform so well during a bear market, but could perform very, very well and could be one of the best performers in a bull market. Hence why it's on my watch list and it's part of my portfolio, because I think that it performs very well next time we get another leg up. This guy says, "Love your work, Volt Inu." Haven't heard of Volt Inu, but it sounds interesting. Rune and AVAX are leading the pack. So we've seen that although it did have a decrease, and this kind of goes along with the thesis that I was talking to you about before, although Rune has those big decreases when the market drops, we also see it pumps a lot harder when the market goes up. So we see Rune actually outperforming AVAX, NEAR, ADA, and Phantom and Sol during this recovery. So obviously we saw Bitcoin push up from 27 back to roughly 32, and we've seen Rune pump the hardest out of many altcoins over this period for that exact fact. And it does perform very, very well because of the mechanism I was just explaining. The fact that when it gets TVL, the Rune needs to be bought up to pair in the Omni pool. So I did a thread on this you can check out about Rune. I broke down what Rune is. It's built on top of Cosmos. Provides cross-chain liquidity, very important to have cross-chain liquidity in crypto, allows you to retain custody of your assets. And the example I showed you before in terms of swapping Bitcoin and Ethereum, this is visualized here. So you add your Bitcoin, it's paired 1-to-1 in the Rune reserve. You swap Bitcoin Rune to ETH Rune in the pool to take out your ETH. No cross-chain swaps, no nothing. And we saw that it has many benefits because you're able to keep your assets much safer. And it also just launched synthetic assets. It's launching a lot of stuff. And I wanted to give you a quick update because I did see, and I know you guys can't really read it here, so I'll give you, a little bit of, I'll basically dictate it for you. They are working actively on integration. So one of the main goals of the ThorChain team is to integrate with as many chains as possible. So if ThorChain really is to be this hub, this centralized DEX, or not centralized because it's decentralized, but this kind of central DEX that everyone utilizes, it needs to have compatibility with many other chains. So we've seen 9 Realms, which is essentially a decentralized asset backbone of Rune. 9 Realms is making a push to get integration with multiple platforms. So we see, you guys can't read it, but we can see Atom. They have a test going for Atom integration. They have an AVAX EVM component integration. They've already wrapped up the drafts of the first client chain. AVAX router contracts done. They're in early talks with the Moonbeam team, as I just talked to you about before, as an EVM compatible parachain. They're exploring integration with Moonbeam as a way to access all Polkadot parachains through an aggregator pattern. And they're also working with AVAX, with an AVAX-based DEX to build out a DEX aggregator and integrate ThorChain into their swap UI. So the reason why I'm bullish on ThorChain is because they're continuing to ship code and they're continuing to integrate. And hopefully by the time this next bull run comes around, they have AVAX, Polkadot, Atom, all these ecosystems integrated, so it really becomes that hub, that kind of cross-chain DEX hub, which is very unique and could be potentially see ThorChain taking away some liquidity from these other individualized layer 1 DEXs. Well, the proof will be in the pudding, but I think it's very interesting nonetheless. So these are some of the projects I like, but obviously now comes the question, is it time to buy? Is this the time to ape? I know a lot of the stuff I was talking about in this video sounds bullish, and that's because in general, long term, I am bullish on a lot of these protocols. But short term, there are headwinds, and I'm not going to come on here and tell you to ape into protocols that I think are going to go down another 50% because you'll likely get much better entries. So let's go through some of the charts, which are signaling to me when might not be a good time to enter, and I'll also go through my personal DCA strategy for some of these protocols. And I'll tell you exactly what I'm doing. So we can see the Rune chart here just before I get into the macro stuff is indicating a break of trend, which is good. It was obviously in this downwards channel for quite some time. If we do break this key horizontal, which we are breaking up towards now, then potentially there's a retest at the $3 region, which could make sense for an entry. And then obviously we have this major resistance coming in around the $4 zone, which is another horizontal resistance. So let's just keep our eye on this one for now. Potentially, if it pulls back to this zone, that could be a good look. But all eyes are on Bitcoin at the moment, which is performing a lot better than many expected after the downwards pattern it showed. It did break through the 30K region. It's showing some nice support around that region, and it also pushed up to 31,600 today. And Kyle drew this chart in for me, and he says that the next kind of key zone, the key TP zone that he's seeing is this 34K region. Obviously, if we broke that, then there's major resistance at 36, and then the 37 is the key horizontal to keep our eye on. So there is potential that we do make a push up to this 36, 37K region in the short term, which would send alts flying for trades. And I'm sure Sheldon on his show is going to be covering a lot of these trades. But personally, as a DCAer, as someone that buys into these protocols and invest long term, because a lot of these are long term buys, that I'm more interested in a sustainable strategy that can rely on long term accumulation at very opportunistic levels, and not necessarily play this kind of trading game. Because I view my Solana and my NEAR holdings as holdings that I want to hold for many years. I don't really view them as my swing trade holdings. Now, yes, I have a percentage of my portfolio which is for swing trading. It's slightly riskier. I'll shave off lots of profits. I'll go crazy with. But my NEAR and my Solana, although I will take profits on them if I'm in profit, I won't go crazy with swing trading them. So I have a percentage of my portfolio which I'm trading with. At the moment, as you can see, I did fund my ByBit account. I'm going to take part in Sheldon's trading. But my main DCA strategy right now is this. It's to buy on extremely red days. It's to buy the fear. You have to be doing the opposite of what the sheep are doing in this market. That is how you become a whale. You have to act like one. And the whales accumulate when no one else wants to. So when the market has extremely red days, not green days, that's when I start executing DCAs. And this is kind of how my DCA strategy is going at the moment. I still see the merit in keeping a large percentage of my portfolio in stable coins because we don't know how low this will go. Although we're getting some temporary relief and some great entries for traders and swing traders, for long-term investors that want to accumulate these protocols over the long term, it's very likely we still see lower levels, and it's very likely that the lows aren't quite in yet, if I'm being brutally honest with you. So what I am personally doing is I'm putting, let's say I'm earning $10,000 a month. This is an arbitrary number to make the maths easy. Let's say I'm earning $10,000 a month. That's disposable income. Then I'd be putting $5,000 of those $10,000 into crypto, and I'm putting the other $5,000 into fiat or stablecoins. This means that I'm continuing to accrue a stablecoin balance, so I have buying power if this market continues to dip. So 50% are going straight into stables. Then I've got another 50% of my investment of my monthly income, which is going towards crypto. Now, this 50% is my DCA portion of my portfolio. So out of this 50%, this is how I'm allocating my funds. So out of the $5,000, I'd be putting roughly $3,500 into Bitcoin and Ethereum right now, split 50-50, because those are the safest protocols in this market. We know that they're not going anywhere, and we know that historically they've survived bear markets and come out the other side. Then I'm putting the other $2,000 to $1,500 into some of these major L1s. So some of the ones I talked about today, Solana, NEAR, DOT, maybe potentially even AVAX. I'm putting money into some of those as well as part of my regular DCA strategy. So out of the $5,000 that I'm investing, $3,000 I'm keeping relatively safe, and then $1,500 to $2,000 I'm putting into some of these L1s. And these L1s are very good risk-reward plays because you're still going to capture major upside, but you're not exposing yourself to a lot of the downside. So where does that leave your ThorChains? Where does that leave your Moonbeams, Moonrivers like I talked about today? I leave them on the watch list for now. So this video just isn't about giving you guys buy calls or buy signals. It's about developing a nice watch list in your CoinGecko of protocols that you want to learn more about. So you have many, many months now to start digging in and doing research into these projects. So I'm giving you guys a few pointers on the projects that I'm looking at, but that doesn't necessarily mean they're a buy. So although I am DCAing into some with small amounts of capital, I'm still keeping capital on the side because if we get more downside and a ThorChain really gets hit, let's say it goes down to $1, that's something I believe in long term. So it's something I want buying power to purchase. So for now, I'm keeping my DCAs a little bit safer. But if that strategy shifts, I'll let you know. Obviously, though, to get the degen out of my system, I am doing some trading because at the moment it's very important to have trading to tick your portfolio along just a small percentage. I put 5,000 in here, which is a small percentage of my portfolio. And basically, I'm just doing it to keep some fiat coming in, have some fun in this market, and pick up the skill and, continue on my TA journey with Sheldon. So remember, if you do want to join along with this live trading series, which I think is awesome, by the way, there's a link in the description to sign up for a ByBit account. Fund your account, and we'll be doubling portfolios on the show this week. I've been speaking to ByBit. I'm going to get the Excel for some portfolio doubles by the end of the week. Super excited to do that on the show. So yeah, sign up, link in the description. And that is basically what I'm looking at on the market right now. Those are some of the altcoins that I like. Make sure to smash the like button if you enjoyed this video. And in the comments, let me know what you guys think of this list. Do you like it? Do you hate it? What did I miss out on? What would you add? Let me know. I think these 5 protocols, they're by no means my exact top 5 because, I probably have a watch list of 50 protocols, but I think they're the 5 I wanted to talk to you guys about today, maybe because I haven't talked so much about them in the past. And I wanted to kind of shine a light on some of them, especially DOT, which I don't cover much, but something I'm going to be covering a lot more. Thank you guys so much for watching the show. I hope you have a lovely day. I'll see you in the next one. Peace out.